tonight we're going to talk about the best ways to maximise the end of the financial year. We've got some of the best in the business down here to talk shop. Agenda for tonight really, we'll start with Hamish from Money Lab. So Hamish, Money Lab are our mortgage broking partners. Then we'll go to GILL from the Property Collective. We've got James Goodwin, he's from BMT Tax. And then we've got Adam Morgan, who just strolled off, but he's from Geocon. He can really look at some of the best offers that we've got and some of the best ways for you to maximise the end of the financial year. I'll hand over to Hamish.
G'day guys, I'm the National Business Development Manager at Money Lab. So probably most of you guys would have seen us before as the mortgage brokers for Money Lab, but obviously there's further parts to our business as well. We're actually the financial planning, accounting business, asset finance, essentially a one-stop shop as our clients come through. So tonight I'll obviously expand a bit further on our business model. Obviously I'll talk a little bit about finance, but obviously we can also talk from our accounting team, which I've got advice off to give you some tips come tax time. Do some property advice as well as we give to clients about how it works with positive cash flow and how tax works against those properties. So hope you find it informative, guys. As I said, reach out through the text messages and we'll go from there. Tax tips. So obviously come to tax time, we're buying a property. There's obviously a few key things to look for. Obviously on the finance side of things, there's some things you can claim. And obviously comes to appreciation benefits, which the team will talk about later on tonight. So these are just a couple of key points that I wanted to cover off tonight with you guys going through the room. So obviously ensuring you arrange a depreciation schedule. So if you have bought an investment property in the last 12 months, make sure you've got a depreciation schedule ready to go to submit as part of your tax return. And obviously the guys will touch in more detail with that later on. Obviously claiming the interest on the loan and insurances against your property. So if you've got a loan, it is negatively geared against the property. Obviously all that is tax deductible, which is obviously called negative gearing. So your accountant will be aware of that. If you're not aware of that, make sure you bring it up with your accountant when you're talking to them, because that is a tax deduction. So if that doesn't make sense, please feel free to reach out to me later on. Lender's mortgage insurance, which is a really common one. So a lot of people, when they go to buy, they've got their own occupied residence. Usually it's under 80% lends, so you're not paying lender's mortgage insurance. But a lot of time when you go to buy an investment property, a lot of times you'll actually have to go into LMI territory. So what that means for people in the room is you'll actually have to go to an 85% or a 90% loan against the property. And if you go down that path, you'll have to then pay mortgage insurance, which is an extra cost to your loan. Obviously, the good part about that is it's actually a tax deduction. This actually gets missed quite often when you actually go to submit as part of your tax return. So when you are sitting down with your accountant, make sure they're aware of that. And it actually gets claimed over the first 5 years of the loan. And it's done through a depreciating value. So the first year, as an example, if you pay 15 grand in LMI, you might claim 6 grand in the first year, 4 grand, 2 grand, 1 grand, up to the total of $15,000. Does that make sense? Yep, so make sure you're aware of that if you are looking for investors, and obviously we're all investors in the room tonight. If you're not, we're obviously keen to look down that path, that you are aware of that it is a tax deduction. If you do have to go down that path, it can still be a positive because it's money back in your pocket. Obviously claiming expenses when available for rent, so that's your body corp, all the things we know about when buying an investment property. They're all tax deductions which go as part of your tax return come tax time. And obviously capitalising all expenses incurred on the purchase. So what that is when you buy your property in the first year, your stamp duty, your legal costs, whatever cost against the property is obviously your tax deduction. Yeah. So when your first year, when you go to buy your property and you go to submit your tax return, you'll get quite a big substantial tax return back in your pocket. For you to do what you do, you want to go to Vegas, go on holidays, do whatever you want to do with it, be a nice income back in your pocket. I'll talk about a strategy later on, but the best way obviously in terms of when you're buying new and you're buying these big tax breaks, it's a really great way to get ahead in life and get positive cash flow back in your pocket, either ones that pay down your current home loan or create wealth in buying multiple properties going forward. And also the last one is land tax. So if everyone's fortunate in the room or you've got plans in life to buy multiple properties, it's really important to make sure you structure it properly that you're not hit by land tax. So whether your family circumstances, trusts, set up companies, whatever it is, if you've got ambitions in life to buy 4, 5, 6 or 7 properties, make sure you set yourself up structurally fine because you'll get hit by land tax. So it's a really, really important thing that some people get hit by because once you start buying multiple properties and it gets over a certain threshold, you can really get hit come tax time. So on the screen is a property analysis. So what we do with our clients when they come through our accounting, financial planning, mortgage broking, we actually run an analysis for them if they're investors. So the best way to explain on the screen and get my big buffet out of the way is this is an example of actually a client that come through our door a few weeks ago, and they purchased a property of $590,000. So this has really resonated with people in the room. This is a normal client, mum and dad, they're on $180,000 combined. They own their own occupied property. So they wanted to buy an investment property, they didn't know how to do it. So we obviously assist them through that process. The clients released some equity and bought an investment property, as we said. And if you look at the screen, they bought the property at $590,000 and they got an 80% loan against the property. So what it is on the screen is it's the analysis against the property they've purchased. So you've got your rental income coming in. So obviously your rental, we've estimated it's going to be at $540 per week. So that's the rental income coming in of $28,000. Then obviously less all the outgoings against the property. And we do this for every client that comes through. Whether you want to buy one investment property or buy 6 investment properties, it's important to have a strategy and structure in place to make sure it doesn't inhibit your cash flow. Then obviously this is the outgoings against the property. So we all know about rates, water, landlord insurance, body corp, all the things that anyone in the room would know about. As an investor, you have to pay as part of the property. I won't touch on depreciation just yet, but with the incoming rent against that property, against the outgoings, this property was already cash flow positive of about $2,800. Yeah, and that's on an interest-only loan of 3.5%, which you can actually get lower rates than that at the moment. Yeah, and that's still a cash flow positive investment. So the client strategy and structure is really looking really positive at the moment. But for this particular client, because they had to release equity from their own purchase, their own home, they were really worried about obviously their loan goes up. Their own occupied property's gone up. They're like, I didn't want to release equity because I feel like they've gone back a step. I'm like, we put the plan in place that they're actually going forward a step because essentially, yep, they've released equity, but they're right about their cash flow scenario. So releasing the extra equity, which is about $140,000 they needed to use out of their own home to go towards this property, obviously their loan repayments went up. Yeah, so they're going, the extra loan repayments are about an extra $400 to $500 a month. They're going, how are we going to pay for this? And this is how they covered it off. With depreciation, which the team will talk about later on, the depreciation against this property, because they bought a new property, where they get to claim their max tax depreciation benefits, they got an extra tax return of $4,500, which equaled the property to be close to $7,500 cash flow positive. Yeah, so then you break that down to the client, they've had to release equity from their home, which costs them an extra $500 now in loan repayments, but they've now made this back because of the tax and the positive cash flow they're getting back against the property. So the client's actually in no worse off position, actually in a better financial position in terms of cash flow. Their life won't change at all because they'll actually be in a better position. They'll actually have more money coming back in their pocket than they were, and now they've got a second property. And their life has not changed one bit. Yeah? And that's how the power of wealth and the power of equity works in buying property. Yeah? And how that works, which obviously we're touching on tonight, is the benefits of buying new versus old. Yeah? The benefits of buying new is how that can happen. The benefits of buying old, you wipe away a lot of those depreciation benefits, which actually would make that viable for that client. And if you break that down further, on that particular property, if that the exact same property, go back a step, exact same property, if this is old versus new, so you're being the first owner of the property, you get to claim the plant and the equipment depreciation, which again the team will touch on later. I don't want to steal your thunder. He gets to claim that against the property. And this gets claimed against every year. This is the 1 year analysis on the property, but you get to do analysis every year. If the property was old, you don't get to claim that $8,800. That completely wipes away. So then if you go against this property as an outcome and how it looks, so if this is the exact same property, the depreciation would be, if that property was 15 years old, the total depreciation against that property would be $2,500. If you bought the property brand new, the total depreciation would be $14,000 in that particular year. So that's a total tax deduction saving of about $11,800. Does that make sense, how that all works? So essentially for ourselves, when our clients come through, that's how we essentially develop strategies in place for clients to hopefully buy multiple properties in their portfolio. Yeah, positive cash flow is a big thing at the moment in the market. Obviously we've gone through COVID. You can still get into the market, but people are obviously worried about buying and they're sort of coming to the market and getting out of COVID. You can see how it looks. It doesn't actually affect your lifestyle one bit. If you can release equity from your own home and purchase, your lifestyle will not change one bit. All you're doing is creating a portfolio in the background. And the reason for that being is that the ability to buy new versus old. That's why new dwellings at the moment are very popular in the market. And for me, that's it. Thank you. Any questions later on, please reach out.
Good evening, everyone. My name's Hannah Gill. I'm with the Property Collective, and if you haven't heard of us before, we're basically a real estate agency in Canberra who do all the things you'd expect a real estate agency to do, from property management through to sales, both established and brand new. But tonight's not about us. Tonight is about my discussion with you guys is about what's happening in the rental market in Canberra and what we're seeing in the landscape in property across Canberra. So, benefits of buying in Canberra. If you're reading any of the newspapers at the moment, you'll know that Canberra is a great place to buy. We've seen for the past 12 to 18 months that vacancy rates are next to nothing. In fact, at the end of the first quarter, vacancy in Canberra was 0.8%. Let me put that into perspective for you. That's actually not a vacancy rate. That's just tenants moving between properties and between settlements and tenants moving in. So in terms of a strong market, you actually cannot get better than that. Second to that, we actually don't have enough stock in Canberra. So there's a massive issue around supply and affordability. There's more tenants than there are property, which is driving that vacancy rate, and equally that is then pushing rents up. So average rents in Canberra are topping out at some of the highest in the country, which when you think about Sydney and Melbourne, that's pretty phenomenal. So it's a great place to buy because we know that's not going to stop anytime soon. We also know that days on markets are holding really strong even throughout COVID. So we expected, like other markets we saw like Melbourne and Sydney that got hit really hard, Canberra barely saw an impact because of COVID. So average days on market at the moment are 29 days. Now between settlement and getting a tenant in many instances if you're buying off plan, you'll actually get early access. So your loss or your period of vacancy is actually not even a cost to you, it's prior to settlement. So that's another really important thing to consider if you're looking at new or established and your opportunity to mitigate any vacancy period. And finally, because of all those things, we're seeing really strong yield and or cash flow in Canberra. So when you're buying apartments in Canberra, and I'll talk through a couple of recent case studies. Grand Central Towers in WODEN. We recently rented 80 apartments there. It took us 6 weeks. We had a 1-bedroom apartment. The owner paid $260,000. There was about 2 days vacancy, and we achieved $390 per week. So if we go back to Hamish's scenarios earlier, that's straight away a cash positive investment, an investment where a tenant's not going to move anytime soon because $390 a week is one of the cheapest apartments you could rent in Canberra right now that's brand new. High Society in Belconnen, 2-bedroom apartment there, the owner paid $517,900, settled on the 6th of May, so this is very recent. It was tenanted just a couple of days ago and we achieved $560 per week. So again, these are incredibly good returns on apartments that are very affordable. But what's important when you buy in any market is to understand what your legal requirements are. And I'm not going to talk to you about legislation for a long time because it's dry and boring, but I just wanted to touch on a couple of key points that have changed in Canberra in the last 12 to 18 months. The first legislation that's changed is that pets can now not be unreasonably withheld consent for tenants. So it's important if you're looking to buy a property as an investment that you're aware of that and you mitigate your risk by putting things in place like landlord's insurance that covers pet damage, for example. The second is rent increases. Rent increases are now capped by the CPI, housing component of CPI, year on year. That's nothing to be worried about as long as you get the right rent the very first time you rent the property, and then we can manage those increases year on year. So again, important to understand that, important to take advantage of that year on year, rather than skipping a rent increase because you might say you don't want to bother the tenant and then falling behind the market. So really important you stay consistent with what the market allows. The third is notice periods. Off the back of COVID, we saw 3 different emergency declarations for rental in Canberra. One of the key points of that, which is still maintained today, is that you now need to give 8 weeks notice rather than 4 weeks if you want to move back into the property. That's a really important thing to consider because your circumstances may change and what is an investment property you may want to then live in. So it's just important to understand your rights and responsibilities as an investor because in Canberra we're quite different to the rest of the country. We're sitting in our own little bubble when it comes to legislation. Finally, later this year, we're going to see the abolishment of the 26-week no-cause notice to vacate, which means we can no longer use that notice if you need to evict a tenant. So those shorter notice periods become extra important. And in the next couple of years, there's going to be the introduction of minimum energy efficiency standards in rental properties. So again, the benefit of buying brand new means you don't need to put heaps of money into getting a property up to standard because it already is up to standard. And in an established property, for example, we'll see expenses of $15,000 to $20,000 for investors trying to deliver that. So in a nutshell, Canberra is a great place to buy, a great place to invest, especially brand new. And I think that's it from me.
Good evening, everyone. Thanks very much for having me tonight. My name is James from B&T Tax Depreciation. We are a quantity surveyor firm specialised in tax depreciation for investment properties. I'm going to run through just a brief presentation outlining tax depreciation and its benefits to all property investors. So what is tax depreciation? Tax depreciation is the wear and tear of the construction and the fit out of a property at a rate set by the ATO. This wear and tear can be claimed as a tax loss each year for 40 years, and it's typically the second biggest tax deduction behind loan interest, claiming thousands of deductions each year, helping with cash flow. Here we've got a quick example. We'll look at a one-bedroom unit in the highest society development, bought for $409,000 and rents for $440 a week, giving us an income of $22,880. Expenses for the property are $24,520, such as interest, strata fees, etc., leaving us the pre-tax cash flow of minus $1,640 per year. We'll break that down here, as we have our income less expenses, giving us a $1,640 loss. When we claim that loss against our tax, we get a refund of $607, reducing that loss to $1,033 per year. Here on the right, same property, but we introduced depreciation to the equation. With a tax depreciation schedule, we found $10,600 to claim each year in depreciation. When we add that to our previous loss, we get a total loss of $12,240 each year to claim against our tax, giving us a refund of $4,529. So with tax depreciation, we have turned this property from negative cash flow of $1,033 to positive cash flow of $2,889 a year, or $56 a week. A difference of $76 per week. B&T can also provide free depreciation estimates for any developments you're looking to purchase off the plan or existing. We have done reports for all Geocon developments, so have free estimates readily available. These estimates can help you create cash flow projections pre-purchase. For brand new properties, we're able to claim both the capital works and the plant and equipment, where we find an average of $14,600 to claim in the first year. Whereas second-hand properties, since 2017, we're only able to claim the capital works, where we find an average of $8,200 to claim in the first year. So while there's still substantial amounts to claim on second-hand properties, there are massive tax benefits to purchasing and renting out brand new properties. B&T also produces tax depreciation schedules for all types of commercial properties, including warehouses, offices, farms, storage units, even airports. Here's an example where the landlord and the business owner can both claim depreciation. For this shop, we made a tax depreciation schedule for the owner of the building, as they could claim the structure, and also made one for the tenant, as they could claim the fit out. They could claim on all the shop fit out they installed. So B&T provides a special rate for Geocon clients. For a brand new unit, we charge $330, normally $660. All other residential properties are $715, normally $770. Our fee is also 100% tax deductible, and commercial properties are quoted on a case-by-case basis. And that's all from me. Thanks very much for your time. I'll be around all night if you have any questions. Happy to answer. We've also got some brochures if you'd like to collect any as well. Thank you.
Hi everyone, thanks for coming tonight. I'm Adam Morgan, the head of sales at Geocon. We've got our whole sales team here tonight if you want to talk to anyone. We've got some pretty exciting offers to give everyone tonight that's registered for the investor evening. So we'll go through those, we'll circle back after a quick presentation, just running through some of our different opportunities and different timeframes we're going to be ready in. So Geocon has you covered across Canberra. We've got developments from north to south. We've got the Tuggeranong CBD, WODEN, Canberra City, Belconnen and Gungahlin. Now a couple of projects we'll run through. Nightfall in Belconnen. This one construction is going to be ready late this year, so depending on where you're at for your next investment, that could marry in quite well. We've got 1 bedrooms there with floor plans on the left from just under 380 and 2 bedroom plans in the low 400s. High Society, that together with Nightfall is part of the Republic precinct. This one, it's already ready. You can go out there any day with one of our agents and have a look through some great opportunities out there. We've got 1 bedroom apartments from 389, 2 bedrooms in the mid-4s and 3 bedroom apartments, you know, for the downsizer or for an investment for $700,000. Establishment, so we've gone out to Gungahlin Town Centre, the north side of Canberra. This one is about to start construction commencement, so a little bit different in the timeline. This one has some really affordable opportunities here, with 1 bedrooms from $308,000, 2 bedrooms from $383, and 3 bedrooms in that mid-600 mark. Metropol, It's probably our most exciting development at the moment because it's coming up for completion. It's just over the road from where we are now in the sales centre. It's on Kooyong Street. It consists of 3 buildings. You may have seen it, the scaffolding just came down. Pretty impressive building there. We've got less than 100 options there available across the 3 buildings, and they're selling fast now. We've got access, but there we've got some great investment opportunities that will come for settlement really soon with mid this year. We've got 1 bedrooms from the mid 400s, 2 bedrooms from the late 6s, and 3 bedrooms from the late 7s. So Grand Central Towers, we've got another building in the WODEN Town Centre. You may have seen it if you've been around the area. It's the very contemporary big glass tower right in the middle of the town centre. We've got really limited opportunities there. They're ready now. You can go out and see them as well. 1 bedrooms from the low 300s, 2 bedrooms in the mid 4s, and 3 bedrooms pretty aggressively priced there in the mid 5s. Aspen Village is in the south of Canberra, the Tuggeranong Town Centre. This one, construction has already commenced, so it's just coming out of the ground now. There's some really good opportunities down there as well, with 1 bedrooms in the low 300s, 2 bedrooms in the mid 4s, and 3s in the mid 6s. So again, we've got Canberra covered. We've got opportunities all around town, different timeframes and different price points, all underpinned by everything everyone's talked about today, the numbers, the rental yields from Hannah, and we've got the tax incentives as well, which a lot of investors are turning to Canberra with our fundamentals being stronger than anywhere else in the country. So if you want to find out more, just talk to me or my team today. We've got some commercial opportunities as well. So we do the residential towers on the ground floor. We're doing predominantly commercial, which you can see across here at the Nightfall development. We've got super aggressive price points there with the commercial opportunities, so cafes, restaurants, really good rental yields in the commercial market too in Canberra, but they're covered as well from Geocon, Braddon, the city right here, Gungahlin, Tuggeranong and WODEN. But thanks for coming. I'll pass you on to Elliot for the Q&A.
Thank you, Adam. So had a few come through. First one's actually for you, Morse. If I decided to invest tonight, how long would it take till I could start taking advantage of? Would it be in time to be able to take advantage of in the financial year?
Well, a lot of the tax incentives tied to Canberra real estate are applicable at settlement. When you're buying off the plan, we generally only need a 5% deposit. However, your stamp duty won't be due until it's built. So we do have some opportunities in some of the buildings I talked about earlier, WODEN and a couple of buildings in Belconnen there that are already built. If you were to purchase now, we're getting into closer to the end of May, so you'd have to turn around pretty quickly in order to settle this financial year. Can be achievable, but again, talk to our guys. But in terms of getting your first investment, that it could also marry up perfectly for the next financial year for when it settles, so you can pay the stamp duty that financial year in capital, get the benefits of the tax depreciation for the following financial year we're about to go into.
I've got a question probably for Hamish. But how does what's the RBA saying about interest rates?
Yep. At the moment, we're not seeing interest rates move anytime soon. So with the construction industry, they're pretty keen to keep that moving along. So I know interest rates are going to be pretty important in terms of that behalf. So for everything we're seeing at the moment, we're seeing interest rates staying pretty solid over the next 2 to 3, 4 year period. But at the moment, that's the feedback we need from the banks at the moment. So we're seeing some rates. You're fixing them for own occupiers in the ones, in the high ones. I saw one the other day, 1.89. Again, you've got to mixture through the 2s up to the 3s, depending if you're going interest only, fixing your rates, keeping it variable, etc. But the moral of the story is there, the interest rates across the board are low, cash has never been cheaper, your rents have never been better, and that coincides with a great investment opportunity, what we're seeing in the market.
Peter, the land tax structure we were talking about, can you elaborate just a little bit on that in terms of you did say avoiding it, but I don't think you can avoid it, but how you might minimise it?
Well, it all comes down to how you structure up your finances. So in terms of whether you set up a company, family trust, etc., to set up the way to save on land tax. So essentially who the property's named in. So if you get to the point in your life where you're lucky to own 4 or 5, 6 or 7 investment properties, it's really important to talk to an accountant or talk to a financial advisor to make sure you're structured up correctly. Because if you just go buy them all in your personal name and you get over the threshold, you get severely smashed by land tax. Because once you buy multiple properties, you actually pay more and more tax against your properties. So it's really important to get to the point, you know, if you've got a partner, you know, do you put more properties in your partner's name, keep some in your own name, set up some structures, company trusts, There's so many different variants around it that only accountant can take you through. But just going out through a display suite, constantly buying properties and creating wealth, and just putting them in your own name every time is most of the time probably the wrong thing to do. You should be speaking to your accountant and make sure you structure up best you can, because it's going to save you thousands, tens of thousands of dollars over the lifetime of the journey of that property to make sure your finance is structurally set up properly, to make sure you'll provide, obviously at the end, everyone wants money back in their pocket and not get into the ATO. So I'd really advise you in that part of your life to go speak to an accountant and get the structure set up first before you make that next decision.
Got one more question here, and then we'll take the rest and put them in the EDM. But how much strata fees on average, and how does that affect the investment?
Yeah, so on average, our stratas across the buildings, it's all relative to the size of the building. You see the pools and the gyms and tennis courts, sometimes they can actually be a negligible cost when you may have 300, 400 apartments in a big complex. You've got your building insurance covered in the strata costs, and you've got some benefits in there as well, but your strata and your rates and your land tax, so they're the three main fees. They obviously, you've got some tax deductions on several of them, however they can eat into your return on the rent. But based on our yields, which Hannah touched on average, to answer the question, you've got 1 bedrooms around the $2,000 mark, depending on the building. 2 bedroom en-suites in the mid 2s to 3,000 per annum, and then you've got 3 bedrooms, 3,000 plus. But it's all depending on the size of the apartment and the size of the complex. But based on the rental yields we are getting and the returns and the super low interest rates we've talked about as well, and the RBA saying they're happy to leave them quite low for several years to come, the cost overall is sort of insurmountable when you're getting that really strong rental return on the investment.